right, everybody, welcome to Investor Fest, New Orleans 2025. Everybody put your hands together for making it out to Investor Fest 2025. And I think this is our biggest turnout yet, so if you look around the room, I think you are part of history. This is one of our record-breaking attendances, so thank everybody for coming. I am Emile Hurst Jr., so we founded West Bank Real Estate Investors, which is a meetup group that we do every month that's on a smaller scale to this. Also founded the company Lease Co., which we do leases and evictions for self-managers and property managers. Okay, Domonique.
Hey guys, my name's Domonique. Thanks again for everyone being here, and we're just super excited to see a room full of people packed with knowledge. We're excited to network, to pick people's brains. This is like the best place to set meetings with people you might be doing your next deal with. So I know I've gotten deals, I've raised money, I've done tons of stuff from networking with people in rooms like this. So, but yeah, I'm Domonique. I run a fix and flip company here in New Orleans. I also run a portfolio of long-term single family rentals. Emile and I both, if there's anything that we can do or introduce you guys to help your journeys in the investing space, we'd love to do that. So definitely chat with us if there's anything we can do to help anybody.
Definitely. So the most valuable part about being in this room right now, this Saturday, this is the opportunity where people who would never be in the room together get an opportunity to be in the room. So you have a 19-year-old wholesaler that just graduated from high school, all the way up to me being a 38-year-old investor that's looking for the next deal. So take this opportunity to meet somebody that you never met before and connect with them to get yourself to the next level. So matter of fact, we'll make it a little bit easier. So by show of hands, who is a contractor in the room? Show of hands, everybody look around. So my rehabbers, my flippers, contractors, hold them up because we got people in the room with cash. All right, hold your hands up, cool. All right, that's our contract, that's our contractors. If you are a realtor, hold your hands high. So if you are a flipper, landlord, wholesaler, you need to network with realtors. At the end of the speaking session, make sure the hands that were up, you go find a realtor. For the wholesalers, please hold your hands high. My wholesalers, everybody's looking for a deal right now. So make sure you connect with the wholesalers so you can buy the deal, sell the deal, get the deal flipped. Any appraisers in the house, raise your hand. Appraisers? No? They may be in a call with the insurance agents. The insurance agents, are you in the house? And the insurance agents, right? Flippers and rehabbers, hold your hands high. So realtors, wholesalers, your end buyers, look around. So at the end, you need to walk to those flippers and wholesalers. Title companies. Do we have any title companies in the room? There we go, look around. So after you get that deal, you buy, you need to close it. If it's with a wholesaler, it will come with problems. So you need a title company that can solve those problems. Right? Property management companies. We got property managers in the house. We got Arpent in the building. We got Grace. Okay, hold your hands high. All right. Property managers, good. And I think that is, did I miss out on anybody? Right? Quick show of hands, who has not closed on a real estate transaction yet? Because you are just as important in the room right now. Hold your hand high. All right, cool. So all of the people that we named before you, it's one thing to reach forward, but I think it's also our responsibility to reach back to the people that's just getting started, because everybody who raised their hands started at zero at some point. So you are in this room to get to your next. Whether you're at 100 to 101 or 0 to 1, this is the room to do that, right? All right.
Absolutely. Yeah, it's such a great variety of people, obviously, in this room. So wanted to give a quick shout out to a couple of our sponsors that are in the back. They are the reason that we're able to do this event and keep it free, which is why there's so many people in this room. So we're so grateful. We handpick the sponsors. We don't just sell tables to anybody. These are only people that we have worked with, Emile and I, and know and trust their business. So it's seriously, there's some great contacts back there. If you are looking for any of these services, highly recommend to check these these folks out. But we got Mike in the back there with Arpent. He does real estate and property management. They're doing a special deal actually just for people in the room today for a $350 tenant placement, one-time fee to lease up a property. But their company is awesome because Mike and his team are actually investors themselves. They own their own portfolio of rental properties, and they treat their properties the same as all their clients. They know exactly what investors need. Then we also got Fleur de Lis Title right over here on the side. I personally just closed 2 deals yesterday with these guys. They are like one of my go-to title companies for anything difficult. They are an in-house law firm as well, so if you need help with successions, specific contracts for partnerships or seller financing deals, anything that might need some more legal help, they are your company to handle all of that stuff. And then finally on this side we got Falaya. Falaya is a real estate service if you don't necessarily want to go the traditional route of hiring a realtor, if you're looking for a cheaper alternative to get your property listed and still on the MLS with a one-time flat fee. But they're a little different from other flat fee listing services because they help you through the entire transaction. They give you transaction support from contracts through escrow with the title companies. All of that is included. So if you're looking for an option to maybe get a little bit cheaper on the resale side, Falaya is your company. And without further ado, let's get into the main event. So we are super, super excited to be joined today by Tony Robinson. Tony, if you've ever heard of the BiggerPockets podcast, it's one of the most downloaded and listened to ever real estate podcasts. Tony is the host of one of their shows, the Real Estate Rookie Show. He also is the host of his YouTube channel, The Real Estate Robinsons, where him and his wife talk all about short-term rentals, boutique hotels, fix and flip projects, all the stuff that they've been a part of. He is a father, a husband, and he flew all the way here from California to be with us today. So we are super excited. Would you help me join in a standing ovation, if we can, for Tony as he comes to the stage?
Bring 'em out, bring 'em out, bring 'em out, bring 'em out. It's hard to yell when the barrel's in your mouth. Bring 'em out, bring 'em out. Hey. Bring 'em out, bring 'em out. Bring 'em out, bring 'em out. Bring 'em out, bring 'em out. VIP coming live from the VIP. Heard the nightlife.
Mic check, mic check.
There we go. All right. Good morning, guys. That was a great introduction. Thank you for that. I just got to bring you with me everywhere I go and just like introduce me into every room because that was great.
Well, we're super excited to have you. Thanks for being here. Welcome to New Orleans. We know you have a ton to share about a bunch of different aspects of real estate. I forgot to mention you're also an author too, so would love to dive into some of the topics of your book and all of that. But to start us off, and just for people who maybe aren't as familiar with your story, can you take us all the way back to the beginning? Because I know your first deal started right here in Louisiana, right? So tell us about that. How did that come about? How did you even get into real estate?
Yeah. So I started investing back in 2018, and I live in California, a very high cost of living market, and I couldn't afford to buy in California at the time. And even now, I don't know if I would, just because it's a hard place to be a landlord. And my mom and my stepdad had some family in Shreveport, just a few hours north of here, and they bought a property out there. And I was talking to my mom about this house that she had bought, and she was just like real nonchalant. She was like, yeah, we bought this house. And the bank funded everything. They funded the purchase, they funded the rehab, and we just had to like sign some papers. And I don't even think she realized like what she just told me. It's like at the time I was educating myself a lot and reading a lot about real estate. And she's like, yeah, I had this bank that just like funded the whole deal. And that was like the intro for me into actually getting my first deal. So I called that bank like immediately. It's like, hey, is this real? Did this actually happen? And it turns out, yeah. If you found a deal with enough margin in it, they would fund everything. And that was my introduction. I bought a house in Shreveport, Louisiana. They funded the entire deal. They actually helped me manage the rehab. They wanted to protect their investments, so they had people going out there and like inspecting the work. But yeah, that was 2018. We got our very first deal, long distance BRRRR, and didn't, I think I was making like $100 a month in cash flow, so it wasn't life changing, but it was proof of concept for me, and it gave me the confidence of like, man, this actually works. And I actually found a video the other day of me like recording myself when I got that first. It's not, you don't get checks, but it was like that email of the direct deposit from the first tenant that moved in, and I was like, man, like this is real. It works. So that was the first deal.
Yeah. So we have people in the room right now that never did a transaction at all. So you kind of went super fast. So I heard you use the term BRRRR. I heard you use the term bank financing. So for that person working on the first deal right now, what was the actual steps? So I know you called the bank, but this property was already owned, or was it a property that you had to acquire? What were the steps kind of to get from that acquisition all the way to collecting that first rent check?
Yeah, so if I were to give like the framework, right, or like the steps to follow, I think the first thing before you do anything is to ask yourself why you're doing this. Like, what is your motivation for getting into real estate? Because everyone has a different motivation, and depending on that motivation, different game plans will flow from that. If I'm someone who loves my day job and I have no intention of leaving, and I just want to build wealth for the long term, that's a very different strategy than the person who, has panic attacks every Sunday night because they hate going to work on Monday morning. So depending on what your motivation is, that will dictate the strategy. So I think that's the first piece, is just understanding what your motivation is. Once you've identified, okay, this is why I'm doing this is what I'm hoping to get out of it, you have to pick a strategy that aligns with that goal and that aligns with your skill set, right? Like maybe, I wanted to syndicate apartments when I first got started in real estate. I wanted to go out and buy like multi-million-dollar apartment complexes, raise a bunch of money, but I failed at that because I didn't have the skill set. No one knew who I was. No one would trust me with money. So you have to understand what is it you're trying to get out of it, and then what is your skill set, and find where those two areas blend, right? So that's the first piece, is just laying the foundation. For me, long distance, out-of-state rentals is what I wanted to do, build cash flow steadily over time. That was my goal. So the first thing I did was I landed on the market, right? I said, man, there's something about this market that's affordable. I've already got a good lending contact. So that's
talking about Shreveport.
Talking about Shreveport,
landed on the
right?
market.
Yeah,
Okay,
so I landed on Shreveport because affordability, I had the lending contact. Once I had that, I just had to define what my buy box was. Like, what am I actually looking out here to purchase? The bank actually made it easy for me because they're like, hey, you need to be, I don't know, I think it was like your purchase price and your renovation costs have to be 72.5%. It was like a very specific number. 72.5% or less of your after repair value. So once it's all fixed up, your total cost can't be more than 72.5%. So I knew then what I was looking for. And I just every single day was on the MLS looking for deals that could potentially meet that criteria. And I eventually found one. Once I had the deal, actually while I was looking for the deal, I was also talking to contractors, getting recommendations from my lender, from my agent. And that was super helpful because they both recommended the same person. So that was like a no-brainer. And then from there, like I said, it was just off to the races, man. But yeah, those are like the big picture things to do first. Your why, your skill set, your strategy, your market, your buy box, and then you start attacking it every day until you find the deal.
And you did all this remote from California?
Did it all remote. I was married. I was, I had a very busy W-2 job. So I worked for a tech company, and my last role there, I was like a senior manager. I had like a 500-person team spread out across 11 different sites in the United States. Ran 24/7. It was very busy. So for me, it was waking up before work. I'd be at my computer at 5 o'clock in the morning. It was after my son went to sleep. At that time, we only had one kid. So it was just squeezing it in where I could to make sure that we were making progress.
Yeah.
So the first early deals, it sounds like were they rentals, or did you end up flipping them?
They were long-term rentals, all long-term rentals.
Long-term rentals, okay. I know today you've kind of shifted your pivot a little bit to be more on the short-term rental space, a little bit in the hotel space you're even jumping into now. What was that transition like, and when did that happen? Was that pretty early on? The single-family rentals weren't going so well, or what made you make that pivot?
Yeah, so my goal when I first started was I knew I wanted to at some point exit my W-2 before traditional, 65 years old, whatever it was. So that was always my goal. And again, the first deal, it was great. It was like the perfect BRRRR because I put no money into it, but I was only making $100 a month. So there wasn't a ton of cash flow there. And my goal, like I said, I was serious. I wanted to be an apartment syndicator. I wanted to go out there and buy big apartment complexes. But I read this book about apartment syndicating, and the first chapter was about building your track record. And you've got to build a track record before anyone will trust you with enough money to go out and buy an apartment complex. So the only reason I even did the long-term rentals was because I wanted to, build my track record. So I did that 4 times in the span of less than a year. We did 4 rentals in Shreveport. And I was like, okay, cool, track record, check. I got it, I'm ready. But as we were trying to do the whole syndication thing, it was just not working very well. We were, so new, we had no experience. People just brokers weren't sending us good deals, and then COVID ended up happening, and then everything really dried up, right? Like just all the deals were gone. So we were sitting on some capital. I had a friend who bought a cabin in the Smoky Mountains in Pigeon Forge, Tennessee. I'm in California. I didn't even know what a Smoky Mountain was. I'd never even heard of it. I was like, what are you talking about? But he showed us the numbers, and they were phenomenal. And I think, pretty quickly after he showed us his cabin, we got ours. Sight unseen. We didn't even fly out there. We didn't even look at it. We're just like, hey, let's lock it up. Let's get it under contract. And that first deal was just I don't know. It's kind of like catching lightning in a bottle, right? This was late spring of 2020. So literally right in the thick of COVID, right? So there just weren't a lot of people out there shopping for deals. So we were able to get a phenomenal deal on that first short-term rental. And I'll just give you guys the quick numbers because this is the reason that we end up leaning into the short-term rental space. We bought this cabin for $590,000. And we used a 10% down second home loan. So our total all-in cost was $60,000 to buy this 5-bedroom cabin. It grossed that first year, I think $150,000, and then we netted $80 on that. And I compared that, to the $150 a month we were getting on the long-term rentals, and I was like, all right, something got to change, Now I will say that was, that was peak COVID, so those numbers have definitely come down. That cabin now probably does $100,000 a year, right? But still, that's significantly more than what we were getting on the long-term side. So that's what caused us to pivot. And then, maybe 4 months after that first deal, right at the end of 2020, I ended up losing that big cushy job that I just told you guys about. And it was Christmas Eve 2020. I'll never forget it. And my wife wasn't working. I was the sole, provider for our household financially. And after I lost my job, we just had this moment of well, what do we do next? And I actually applied for other jobs, but I just wasn't getting the offers that I felt that I deserved given what I had done in the workplace, And so whatever, we took a break. It was Christmas. I was like, hey, let's just enjoy Christmas. Let's figure things out after the new year. After the new year comes, my wife and I sit down and we're like, well, what if I just don't go back? What if we just take the next 12 months and we just see how far can we actually grow this portfolio of ours? And at that time, when I lost my job, we had the 4 long-term rentals still, and I think we had 2 active short-term rentals. And I was like, let's just see how far we can go. Worst case scenario, I'll just go back and I'll get a job. That's my worst. That's the worst possible thing that I do is I go out there and I get another job, which is what everyone else was doing already anyway, right? So it's not that bad of a worst case. And my wife was on board with that, and we spent pretty much all of 2021 just grinding. And we finished that year with 15 Airbnbs. So we went from 2 to 15 in the span of 12 months, and it was just complete chaos. But that was what we needed to show us that, okay, cool, this is what we were meant to do.
Talk to us about acquisitions. So for the people in the room that either just bought their first rental or they just bought their first personal house, and they just scratching their head to figure out how do I get to the next one. You grew yours to 4 rentals. What was the process of acquisitions looking like? Where did they come from, and how did you close those deals to get to those 4?
Yeah, so for the first 4, it was the first 2 came off the MLS. So they were literally just listed properties. I just lowball.
Through a realtor? Through
a realtor. Yeah, okay. Yeah. So I had a realtor that I was working with. And for me, if you're brand new to this, I would recommend working with a good realtor who knows the market because they're going to give you way more insights than you'll get just trying to figure it out yourself, So I worked with the realtor for those first 2 deals. She was one that encouraged me to lowball both of those offers, and they both got accepted. And then the second two came from a wholesaler that I met. I think I just found him in a Facebook group or something. And he sent me 2 off-market deals that we ended up closing on as well. And same thing for the first short-term rental. It was just on the market, you know? So I always go there first. Like, the MLS is so, like, it's there, you know? And I think everyone gets so caught up on, oh, well, you know, the price it's listed at doesn't make sense. Who cares what it's listed for, you know? Like, put your offer in at whatever number makes the most sense for you. And I'm lucky enough that I've got good relationships with agents that I do work with, where they're fine if I send them 15 properties. You know, I'm like, hey, here's a low ball offer on 15 properties, and they'll send them out for me, you know? Most of the times they say no, but all I need is one yes, right, to get that deal. So that's been our process for on-market stuff.
And what about the short terms? You went through the same process, market, wholesaler?
Yeah, so for short term, we've done a little bit of everything. We've done on market, working with agents. Relationships have actually played a big role in us growing that portfolio as well. So once you start buying a few properties, as you guys all know because you're in this room, your network starts to take notice, and they start to send you deals that match what you're looking for. So we got a few off market that way. We did some cold calling. We did direct mail. We worked with wholesalers. Like, we've done a little bit of everything on the short-term side to help us find that scale. But honestly, the majority came from relationships. We got connected with a few folks in California, and we ended up buying, like, I think 12 properties from one guy, you know? So relationships definitely helped us scale pretty quickly.
So you mentioned you're in California. You started buying the short-term rentals in the Smoky Mountains. Tell us a little bit about how did you choose that market? And I know you're in a couple other markets now too. Like, what are you looking for to determine that a market is a good fit for a short-term rental?
What I do today is very different than what I did then. Because then I didn't do anything. I just saw this guy who was doing okay in that market. I was like, cool, let's go do that. And like I said, sight unseen, didn't even know where it was on the map. I was like, hey, let's just buy it and see what happens. Now we take a bit more of a measured approach as we're looking at and evaluating markets. And again, like our main niche is short-term rentals. We've got just under 30 single-family homes. We have a boutique hotel that we own and operate as well. So we've matured a little bit in terms of what it is that we're looking for. But I'll give you guys like I guess first, let me give you a brief history lesson on. Does anyone in here do short-term? Is anyone in here doing short-term rentals? Okay, there's a few hands, right?
We'll tell you why that's a bad question for this room.
I know, yeah.
We'll get to that in a minute.
Yeah, I do keep up on regulations. I know regulations in New Orleans are pretty tricky. Yeah, it's like New Orleans, NYC, Dallas. There's a few cities that are like getting kind of crazy with it. But like a brief history of short-term rentals, right? Pre-COVID, it was a very niche strategy, right? There weren't a ton of people doing it. COVID, much like me, people saw an opportunity, they jumped on it, and there was this like gold rush in the Airbnb industry from 2020 to about halfway through 2022, maybe into 2022, right? But what we saw was that a lot of people who had no business trying to buy, manage, own Airbnbs bought, managed, and owned Airbnbs, right? And what happened was the rate of supply just nationally far outpaced the rate of demand, right? So demand was still going up. There are more people booking Airbnbs today than there were in 2019, 2018. Like, that's a fact. But the number of people who were jumping onto the platform to add their properties increased faster than that demand. And basic rule of economics, right? Supply and demand. If you get more supply than there is demand, prices come down. So we saw, again, probably peaking in 2022, just like nationally. 2023 was a down year. 2024 was a down year. 2025, that rate of increase in supply has gone from like, 20% nationally to single digits. So what that means is that the market is maturing. The people who are dabbling are starting to leave. And the folks that are left are people like me who are really just doing this as like their main source of income, which is good for the industry. So that's just like, I just want to give like the overall idea of like where the market's at so you guys understand. So what we look at now when we're evaluating places to go are a few things. I want to look at supply versus demand, right? Like, how has the number of listings in that market changed over time, right? If I look back the last 3-4 years, demand in a market, are people booking more today than they were a year ago? I want to look at occupancy changes, right? Are properties more empty or less empty today than they were a year ago? I want to look at rates. What are people charging? Is it more or less than it was a year ago? So you start to look at all these different factors to gauge how well is that market doing economically, and then the regulation standpoint, right? I honestly, I do that first, right? Like what is the regulatory landscape in that city, and is it safe for me to go there? None of the properties that I own would work as a midterm rental or a long-term rental. Like no one wants a 5-bedroom cabin in the Smoky Mountains for 6 months. Like people just don't do that, right? So we want to make sure that when we buy in markets, there's a strong economic incentive from those cities to protect short-term rentals. Like, I go to New York City because it's been in the news a lot for their short-term rental ban, and New York City effectively banned all short-term rentals. But why was New York able to do that? Because think about what New York City is. It's like a global economic center of the world. Every conceivable industry exists within New York City. Business headquarters, Wall Street, film, theater, like university, like everything happens in New York. Fashion. We just bought outside of Zion. Can anyone think of a single business that is headquartered near Zion National Park?
Where is Zion?
Zion's in Utah.
Oh.
Yeah. Point proven, right? Where is Zion?
I don't know.
We wouldn't even know where it's at on the map. So that's why we target those kinds of cities, because what's driving and propping up those economies are people coming and staying in short-term stay accommodations, whether it be hotels or single-family Airbnbs, and that economy would get like obliterated if they turned off short-term rentals because people wouldn't have anywhere to stay. So we're looking, how is the market performing from a KPI perspective, but then what does that regulatory landscape look like as well?
Gotcha. It sounds like you got to the point where you start to get some traction. You got 4, you found new gold with the cabins. So once you start getting that rhythm of things going good, you made it out of getting laid off. So that sounds good. Talk to us about when it goes bad. So the rhythm is going good. What's the first moment now where you get punched in the face business-wise, being fully self-employed? What did it feel like, and how did you come up out of that?
Yeah, it's happened a few times. I think the first time we actually, again, we have a hotel near Zion National Park, but we got that in 2024, we launched it. But we've been trying to buy a hotel for probably 2 years prior to that, right? And the first time that we tried to buy a hotel, it was this beautiful kind of like cabin resort in a lake town in Southern California. So beautiful property, a tremendous upside. I had negotiated like what I felt was like the best seller finance terms I'd ever negotiated in my life. Like everything was perfect. The only downside was we needed to raise $6 million to buy the deal. And prior to that, we had raised a lot of money. Like for every other deal that we had done, like cumulatively, we'd probably raised like several $1 million across all those deals. But the most I'd ever raised on a single deal, like if I'm like raising money for a flip or something, maybe $600,000 for like a single deal, right? And now I had to 10x that to $6 million on one deal. And we failed. And we were like just under we raised like just under $4 million, right? So it wasn't like a complete failure, not like we didn't raise anything. But $4 million is not $6 million. I couldn't go to the seller and say, hey, look, I'm 80% of the way there. Can we still do the deal, So we ended up losing that deal. And the reason why I say I got punched in the face was because 2 things. One, just like financially, like due diligence, EMD, all the stuff that goes into like trying to make this deal happen. We lost, gosh, I don't know, probably over $100,000 just like in like soft costs of like trying to put this deal together, right? And then the second piece was just like I guess maybe like the mental punch in the face of like how silly was I to think that I could go from $600,000 on one deal to $6 million on one deal, and it'd be just this easy walk in the park.
You're talking like self-doubt.
Self-doubt, but just more so like it was just like a lesson learned for me, It's like, if you're entrepreneurial, you probably, if you're anything like me, you have a tendency to like shoot for the moon on a lot of things that you do. And sometimes that's great because it gives you the confidence to like try and go for big things, but sometimes it can make you fall flat on your face, because you reach a little bit too far. And I think that was the lesson I learned in that situation was like, start a little bit smaller. Right? Like you don't have to go from 0 to 100. You can go from 0 to 25, or 50. So trying to identify what those intermediate steps are. So we tried that. We found another deal probably like a year later, and we had raised, again, almost $4 million that first time. So the second deal, I was like, well, what if we just find a deal that we only need $4 million for, right? And you would think that would work. That one didn't work either. That deal did not work either. That one's slightly different because it was new development. So it's just like a slightly more risk, and I think investors want a slightly different profile when they're looking at those kind of deals. Same thing, probably lost like another, I don't know, $75,000 on that. Like, guys, like if you ever tried to syndicate a deal, like the legal fees alone are like $30,000 just for the paperwork, right? Before you do anything else, you got to write a check for $30,000. So I got tired of just like turning my lawyer into a charity, So I said, the next deal that we do, it's going to be so stupidly small that we can't fail. And that's what we did. So we kept looking. We found this property in Zion, and it had been listed for a while. I think the sellers initially wanted like, I don't know, over $2 million for it. And we were able to get them down to $1 million purchase price. They seller financed 80% of it, so we put down $200K. They gave us a 10-year note. I think interest rates like 6%, and first 3 years were interest only. And to take the whole deal down, I think we needed like $700,000. And we did it, finally. I had one that actually made it across the finish line. So for me, it was just like, dude, can we just scale it down to like its most essential, simplest form, get really good at that, and then start scaling back up that way. So we got that first deal. We're looking for another hotel right now in that same kind of mold. But yeah, several times we got punched in the face just trying to get this first hotel deal done.
So I want to button up the end of that question. So what did you learn as far as managing the failures, right? So it's one thing to get to your first deal and it blow up, but it's another thing when you've done 25, 50 deals and you kind of feel like I know what I'm doing and they continue to blow up. So what's the biggest takeaway as far as managing that failure and that self-doubt to get to the next deal?
I think I've just always told myself that failure is a necessary part of success.
Okay.
And I've never really been afraid to fail because like most failure is not fatal, Now, I wouldn't recommend anyone go out there and like bet their whole life savings, on one deal. But failure is a necessary part of being successful. And one of my mentors told me like early on, the saying was, a smooth sea never made for a skillful sailor. And that stuck with me so much because it's like, when you go through those moments of like, man, this fucking sucks. Sorry,
yeah.
Can I say?
Yeah, that's fine.
Like,
we'll edit it out.
But we've all been there, right? You're in these moments where it's like, man, like, do I even want to be in real estate anymore, But it's like when you go through those moments, it makes the next time you go through something like that so much easier.
Okay.
Because you've already been there. You're like, well, I know that I'll see through the other side. So I think just reframing what failure actually means, where it's not something that should stop you. It's just something that you need to learn from. Something that's making you a better version of yourself. And when you go at it with that perspective, it's a little bit easier to get through it.
Okay.
Yeah, that's awesome. You mentioned a little bit about the financing part, and that was kind of holding you up on some of these deals. Kind of want to touch on that because that's very universal. Whether you're financing for a short-term rental that you might have been doing, or earlier on, some of your long-term rentals, or just a flip, whatever it is, there always seems to be that gap when you're kind of starting, and especially when you're scaling, where you're building relationships, you've got the hustle, you're finding deals, and it may sound great to see a cabin in the Smokies with great numbers, but how do you actually get it? How do you actually put the pieces together to buy it, especially when you're just starting out? So what did that look like for you, either just early on or as you started to scale? Like, how were you going about raising money or bringing your own capital or partnerships, whatever it was, to the deal to get these to the closing table?
Yeah, great question. So the first several deals that we did, like I was fortunate enough where we had enough income from my day job to just like self-fund those deals. But then I lost my job, right? And when you lose your job, you don't get paid anymore. So all of the money that we had saved up for real estate, that now became our nest egg to cover us for that year. So the goal for us was, okay, well, how do we scale without any money, right? Like, how do we actually keep growing this portfolio when all of the funds that we have can't be used for real estate anymore? And what we leaned into was partnerships. And we've done equity partnerships. We've done debt partnerships. We've attended the syndications, but for us, it was really leaning into the network of folks that we had built to help us scale. So we bought 12 properties in 1 year, right? Basically a property a month. And every single, I guess maybe 10 out of those 12, we had some sort of money partner on those deals. I think I'm in a slightly unique position because I do host a pretty well-known podcast. But I want to tell you guys like a quick story. So do you guys know BiggerPockets? Have people heard of BiggerPockets, right? So, one of the largest real estate education websites in the world. Their podcasts are some of the most listened to podcasts in the real estate space. And I'm very fortunate enough to be one of the hosts on one of their podcasts. And that's unlocked like a world of opportunity for me that I couldn't ever have imagined. But here's what people don't know. While I was working that day job, doing real estate, 5 o'clock in the morning after work, I was also running my own podcast. So before I got the host of, to be the host of BiggerPockets, before people knew me as Tony J. Robinson, I was just Tony. And Tony had this bright idea, and this was before I didn't even have my first deal yet. I just said, hey, I want to start a podcast where I interview people about the first real estate deal they'd ever done. It was called Your First Real Estate Investment. And I started it by myself. I was the talent. I was the editor. I was the guest coordinator. I was the marketer. I did everything. And when I first launched the podcast, I was putting out I was putting out 5 episodes a day. Not a day, 5 episodes a week for the first probably 8 months. So every day, Monday through Friday, an episode was dropping. That wasn't super sustainable. So then I dropped it down to 3 episodes a week, so every Monday, Wednesday, and Friday. And I did that for over a year. Didn't have a ton of people listening, but I still kept at it. And guess what happened from that podcast? The very first partner that ever funded one of my deals found me through that podcast. Not through BiggerPockets, but through Tony's little no-name podcast that people don't know about. So I think for anyone that wants to raise capital, you've got to find the platform that you can lean into and not focus on doing it for a month or for a quarter, but I want you to commit to doing it for a year, even if nobody's listening. Even if it's just you, and your grandma. Because even if no one's listening, and this is the mindset that I gave myself, right? It's like, even if no one listens, if I do 5 episodes a week, 5 times 52, that's, what is that math, 110, 115 episodes? That's 100 plus people that I'm going to meet who are also active real estate investors. And that was my goal. Like, even if no one listens, every single year, I'm going to be able to meet 100 new real estate investors who are doing this on a daily basis. And guess how I got the BiggerPockets thing? One of the people that I interviewed introduced me to their producers. I could have never planned that. So I would encourage all of you guys to find a platform that you can lean into. Now, not everyone's going to want to talk in front of a microphone. I don't dance on TikTok, you know? So you got to find the platform that resonates with you. Maybe it's putting together events, hosting your local meetup. Find something, but lean into it to really build your network. And then when you do have a good deal, don't be afraid to present it to people. I think one of the challenges that a lot of people have when it comes to raising capital is they view themselves and the money partner with this kind of like balance, right? But that's not what it is. If you've got a really good deal, you're giving them a great opportunity. You're giving them a great opportunity. Like for like a lot of you guys slip in here, right? Think about when inflation was going crazy and people who just had money sitting in the bank. They were not only not getting a return, they were actively losing money that was sitting in their savings account. So if I could go to someone and say, hey, look, give me, $300,000 for 6 months, and I'll give you a 10% annualized return, who wouldn't want that? I'm losing money with it sitting in my savings account, or you're going to help me get 10%? So you've got to rewire what it means when you're presenting opportunities to people, because that's what they are. They're opportunities. It's not a handout, right? You're not a charity. You're giving them a business opportunity. So anyway, I'm going off the rails now, but you guys get what I'm saying.
Yeah, I'm glad you mentioned that, because partnerships is, I think, one of the things that could catapult your real estate career, but it could also be one of the things that could destroy it also. So have you developed a framework to either kind of screen partners, or what is it mentally that you go through? Let's say if you meet somebody in a room today, hey, I'm in New Orleans, I got $1 billion, I want to invest in the Smoky Mountains in Zion, Utah with you. How do you screen partners to make sure that the partnership does not go left, and make sure that it's a benefit instead of a burden?
That is a great question. Like, real estate partnerships they're like a marriage, you know? Like, you guys are buying a tangible asset together with a mortgage, with risk, with liability, you know, especially if you're doing something like short-term rentals, you got people checking in and out all the time. So you've really got to make sure that whoever you're doing this with is someone that you enjoy working with. I think my first advice would be to date someone before you marry them. And what does that look like? Obviously get to know them first, but like, if you guys can do a short-term deal together first, like, hey, can we partner on maybe like a flip first, where we're in and out 6 months to a year. That way, if it doesn't work out, there's a very clear end date on when this partnership will come to an end. It's when this property gets sold, right? So I think always trying to date someone before you get into a long-term, like, hey, let's own some real estate together. The second thing that I'd say is have difficult conversations up front. I think people get into trouble in partnerships when they shy away from some of the more difficult conversations. But I'm telling you guys right now, it's easier to have those difficult conversations at the beginning than as opposed to actually being in a difficult moment. Because if you're in a difficult moment, tensions are probably high. And now that desire to really think about the best interest of the other person is probably reduced. So if you can have those tough conversations when everything's good, when you both are very level-headed, when you're both thinking about what's best for the partnership, it's easier. So ask questions like, well, hey, what happens if, I don't know, what happens if you get divorced, you know? And your wife doesn't want to do this, or like, how does that work? What happens if I want out? What happens if one of us needs some liquidity? What happens if one of us doesn't want to manage this thing anymore? Just all of the worst case doomsday scenarios, trying to answer those questions up front. And then put that into your agreement. Put it into your partnership. Put it on paper, write it down. So those are just like two things. Now, what we've done in our business, because we couldn't always date these people before we like got into business with them. And a lot of the folks we've partnered with are people that I'd never met before. Right, they're people who would come through our marketing channels, people who booked calls with me or with someone on my team, and like we were just meeting them for the first time as we were talking about this deal. So what we added into our partnership agreement was this 5-year clause that said, unless both of us agree to extend this partnership, the default option is that we sell at the end of year 5. And that just kind of like releases some of the pressure of like, well, hey, what if this doesn't work out? Because we all know in 60 months, we're going to walk away regardless. So I think having some sort of out clause is super important as well if you are stepping into a longer term deal with someone who you don't have a strong connection with already.
I got one. The other partnership, right, which is marriage. What lessons have you learned with managing that dynamic with your partner being one way and you being one way in business, because you guys are in business together, and then still having to have your business partner and your spouse in the house at the same time? Like, you can't leave the office. So what have you learned as far as managing that dynamic of that partnership in the mix with the other partnerships also?
Yeah, so my wife, she's my business partner as well. So like pretty much all the deals that we've done together. I think we're lucky. Like, you know, I'm 34 right now. My wife and I, we've been together since we were 17, right? So like most of my life, we've been together. So we have just like a really good working relationship as like a couple. And I think we just naturally know where my strengths are, where my weaknesses are, where her strengths are, where her weaknesses are. So as we built our business, we just kind of both naturally fell into the roles and responsibilities that worked for us. Now, that said, it definitely wasn't perfect, and there were some bumps along the way. Again, we do short term, and I can specifically remember a day where we both, like we were not in the same location. A guest messaged on the app asking a question, and this is when we were still both responding to all the guests, and we both responded at the same time with different answers. So we got home, and I was like, we got to figure something out, right? So what we did, has anyone read the E-Myth by Michael Gerber? E-Myth? Yeah, it's a great business book. If you guys haven't read it, it's just a good foundational business book that works really well for small businesses. But one of the things we did early on that we got from that book was we built out an org chart for our business. And at the time, it was just me and her, and we had one other partner, so it was 3 of us. We had like 30 different roles, right? And we just put one of our names in every single one of those buckets. And once we did that, it gave us more clarity on who should be doing what, right? Who has ownership over what tasks, and there was less confusion over, oh, did you do that, or am I doing that? Like, now we just know, like, hey, this is your lane, this is my lane, let's make sure that we stick in it. And for my wife, her work experience as a W-2 employee was slightly different from mine. She was usually part of a team. My experience is usually leading a team. So for her, she struggled at times with, now we've got like virtual assistants, we've got cleaners, we've got like contractors we're working with, where she has to lead people, and at times she would feel like not well equipped enough to do that. But I said, look, babe, like, I trust you to make mistakes. Like, it's fine if you make, like, we're all gonna make mistakes, so I trust you if you make a mistake. And I think just us having that conversation also helped her kind of like flourish in the roles that she was doing. So I think if you're working with your spouse, just also giving them that breathing room to say like, hey, we're all gonna mess up, and give them that grace, and those mistakes do happen.
And if you make
And I've made mistakes too, right? So I'm not saying that it's just like I've probably made more mistakes than her, but just like making sure that we're giving each other that grace.
and if she make too many mistakes, you got the 5-year clause. Yeah, that's it, right? You got. I'm joking. What you got, Domonique?
Couple more quick ones, then we will open it up for a little bit at the end for Q&A. But I kind of want to touch a little bit too, just, I know you've scaled mainly on the short-term rental side, and I know a lot of people can see that from the outside looking in as, potentially a great way to scale your rental revenue really quickly, double your cash flow, triple your cash flow. What are some of the things, though, that we may not see if we haven't done that strategy that are actually like major challenges with the short-term rental strategy?
Yeah, it's a very active business. It's a very active business. It's not passive income. Anyone who tells you that investing in short-term rentals is completely passive is lying to you. We have, on any given day, 13 different properties that are turning, meaning someone's checking out at 10 a.m., someone else is checking in at 10 a.m. We're like in peak season right now with the hotel, so it's a smaller hotel. It's only 13 rooms, but we're like solidly booked every single day. You're dealing with different personalities, you're dealing with different demographics, you're dealing with different mindsets. It's like every day presents like a new type of person to interact with. So there's just a lot more that goes into the short-term rental space. Just like, that's the first thing, Now, like we've actually built, is anyone here using virtual assistants in their business? Virtual assistants? Yeah, guys, I would, if you've even got one property, but you guys have goals of expanding beyond that, I would encourage you guys to, even on a part-time basis, hire a virtual assistant. And the reason I say that is because as an entrepreneur, I think it's so easy at times to get bogged down in smaller details that pull your time away from the bigger business building activities. And as we were building our business, I oftentimes found myself doing things that weren't the highest and best use of my time. And I started to keep this list. And it was at the top, it just said, things I don't want to do anymore. And as I found myself doing things that I didn't want to do, I would just add it to that list. And then I hired my executive assistant, who's here stateside, and we hired virtual assistants. And like, as we started to put people in place, I was able to delegate a lot of those things. Even today, I still have that list. It's a different list now, right? But I still have that list of things that I eventually want to delegate. So I would encourage all of you guys to, even if it's like 5 hours a week, find a virtual assistant to help in some part of your business, and you'll see how freeing it feels to spend $4 or $5 an hour to get back how much do you value your time at, right? But going back to the point, right? Like what are some of the challenges? So that's the first one. It's just like the management workload is more difficult, but when you layer in the right people, the right processes, it definitely does become easier. The second thing is that the short-term rental industry, the competition is increased pretty significantly, depending on your market, right? Some markets not as much, other markets incredibly so. And I think the people who are succeeding are the people who are continuing to reinvest back into their experiences of their portfolio. We haven't purchased as much in the last, 18 months, partially just because it's getting a little bit harder to find good deals, but also because we've been reinvesting more back into our existing portfolio. We've been adding amenities that people want. We have an in-ground pool that we're doing right now. We have two actually that are in construction, one that we just launched last year. Because in-ground pools are amenities that people want that are more difficult for other hosts to replicate, right? So you've got to make sure that you're always, and this is a lesson that we learned after the fact, you've always got to make sure you're setting money aside to reinvest back into your business. And we weren't doing that. We were like, oh man, this is great. This cash flow is amazing. And we have reserves, but reserves are different. That's like, when your roof goes out, when your water heater goes out. I mean a fund of money specifically for reinvesting back into your business, whatever that looks like. So even if you're not in the short-term rental space, like if you own long-term rentals, how can you reinvest back into that business? Is it hiring people, right? Is it adding maybe amenities to your common areas? Like whatever it is, but how can you reinvest back into your business to make sure that you're continuing to operate at the top 10% of whatever your market is, whatever your niche is? So that's the second thing, is just making sure that you're always reinvesting back into your business. And I think the third thing would be, and I don't know if this is necessarily like short-term rental specific, but it's a challenge that we had, but scaling too fast can also create challenges, And I think social media makes, scaling, and I'm probably guilty of this too, can make scaling sound sexy. And oh yeah, we scale to X number of properties in this crazy short period of time, and it sounds amazing, but it is also incredibly hard. And sometimes you can build problems into your business if you don't scale in a more controlled fashion. And you don't recognize it until that problem comes and slaps you in the face, So now that we're doing more hotels, we're being very, very diligent about scaling responsibly and not just scaling for the sake of scaling. And just because someone presents a deal to us doesn't mean that we have to buy it. When we were scaling the single family side, if someone sent a deal and looked good, we were like, yes. And we would be setting up 3 properties at one time, And now we're trying to understand, okay, I'll give you guys a quick example, and then I'll shut up for this answer. You guys, Charlie Munger, he's like Warren Buffett's partner. He has this book called Poor Charlie's Almanac. Has anyone read that book, Poor Charlie's Almanac? Yeah. It's a very boring read. It's very dense, but there's a lot of good concepts in there. But one of the things that he said in that book that stuck with me, he was like, I think if I could do one thing to make every person on this planet a better investor, I would give them a punch card that had 20 holes to punch, and those 20 holes would represent all of the investments they can make for their entire life. And once they've punched all 20, they can't buy anything else. And when I heard that, it kind of shifted my mindset. I'm like, okay, how do we want to invest moving forward? Do I want a bunch of deals that are doing okay, or do I want just a few deals that are doing phenomenally well? So we're really focused now on slowing down the scale and really trying to be more snipers in the deals we're taking down. And I think that was the mistake that we made, or lesson that we learned, was that scaling for the sake of scaling sounds fun, but sometimes it's not all that fun.
Yeah. What's the challenges with scaling? So for the person that never has done a deal, they want to get to 1. Then after they've done the 1, I want to do 10, I want to do 100. For the business that's been doing well, that's at 50, and they have their employees and virtual assistants, and they want to get to 100 or 500, from what you've seen, what's the challenge with getting what you asked for, basically, and getting success in a short amount of time? What does that look like? What's the challenges with that? It sounds good, but what are the real-time challenges?
Yeah, I'll give you guys some real examples, right? So we scaled so fast in Joshua Tree that we didn't have cleaners to clean our properties. So we literally had to start our own cleaning company in Joshua Tree because we couldn't find enough cleaners to support our business, right? And even now, I'm so I don't hate the cleaning company, but oh my God, it's such a pain in the ass to run that cleaning company, So it's like, man, like if we just would have had a smaller portfolio, a little bit more optimized, maybe I wouldn't have to also, be out here interviewing cleaners to join our cleaning company, right? Another example is, again, reinvesting back into your business. We realized, gosh, I don't know, maybe early 2021, that adding a hot tub as an amenity in that market, which it hadn't been done a lot yet, really had a strong impact on revenue, right? But we had 16 properties in one market. Each hot tub costs $7,000, right? So 7,000 times 16. It's a lot of capital to put down at one point for hot tubs. Yeah. Not to mention the electrical install, not to mention the permits you got to pull. So when you've got more properties, you've also got to make sure you've got enough money in reserves for not just roofs, but like improvements, right? So making sure that you've got enough capital to actually fund the improvements in your property. And then I think the last piece is just like the systems and processes, and that was like the biggest piece. Managing a short-term rental, there's so many different things that can go wrong. There's so many different parts of that journey. You have the listing itself, like what people see on Airbnb, making sure that's always optimized. You have, once someone actually books, what does that journey look like? Like, what are you saying before they get there to make sure that they're, set up and they've got everything that they need. Once they're actually at your property, how are you handling, if someone books your property and they say that something's broken, how do you handle that? If someone wants to check in early, how do you handle that? If your cleaners show up at checkout time at 10 a.m., the guest isn't answering, how do you handle that? And there were just all these things that kept popping up where it's like, how do you handle that? And I think if we were handling that for one property, we could have maybe developed a more robust solution. But because we were doing it for, close to 30 properties, it was a lot of Band-Aid fixes and things that kept breaking over and over again that we'd have to go back and fix again and fix again and fix again. So I think you should only scale according to your ability to solve problems effectively. Like if your portfolio gets so big that you can't effectively solve the problems that are happening, you're probably too big. And that's where we were. Like everything was a Band-Aid fix because there's it's like you're on the sinking ship and you're trying to plug all these different holes that are popping up, but you're not actually solving the problem, right? So scaling too fast sounds sexy, but if you can't actually solve the problems that come with it, it just creates more headache.
Yeah.
Does that answer the question? Did I answer the question for you?
Yeah, it does. And I'd like to add to that, ChatGPT always helps with solving those problems. So if you enter those problems.
We didn't have that when we were starting,
Yeah, well, we got it today. We got it today. So before we take questions, we're going to move the mic around. Mike, you help us out? Yeah, Mike will move the mic around. Before we take questions, what advice does Tony today, if you could go back and talk to the Tony when you first got started, what advice are you giving to that Tony?
Yeah, that's always a tough question because I don't know if I'd change anything because everything that we did got us to where we are today, So I don't know if I'd necessarily change anything because, like I said, those lessons, those failures, they've made me a better version of myself. But I can tell you what we're doing differently moving forward based on what's happened in the past, right? We did a lot of equity partnerships where most of our deals were like 50-50. We own 50%, our partners own 50%, we just split it all down the middle. We're not doing that anymore just because we've done enough of that. And like our main strategy right now is either buying bigger, which is why we're buying things like hotels, or on the single family side, we're just using debt to buy properties, buy them, renovate them, refinance, pay those private money partners back. That way it's just us on the deals moving forward. So we've got enough partners, and these aren't, in a syndication, if you guys are familiar with syndication, right? Like probably this hotel was syndicated, where one person raised millions and millions of dollars from a bunch of other people to buy this hotel. But then the person who raised that money, they have all the control, right? So like they picked the chandelier, they picked this, they picked the rates for the room rental today. The person who raised the money is controlling that deal. That's a syndication. Ours are not syndications. Ours are partnerships, meaning the people that we raise money from have a say. And we would bring designs to people. And, this is like our 10th time designing an Airbnb. This is their first time. And they were like, I don't think that's going to work. Based on what, So I think just making sure that we've got the control over our assets is super important to us moving forward. So that's probably the biggest, change that we're making is we're only trying to partner on bigger deals where we can really keep the control or smaller deals where it's just us.
Cool. Questions from the audience. Just raise your hand and Mike will come with the microphone.
Test. How's it going, everyone? My name's Will. Drop the card. Based in Slidell, I'm also in the boutique hotel real estate space, which is it's been awesome. Markets New Orleans and Latin America. And question for you based on that is, whenever you are presented a boutique hotel deal, what are some of the things you're looking for when being presented a deal?
Yeah, great question. So our buy box right now is pretty tight for the boutique hotels. We're specifically looking for 10 to 30 rooms, so we want smaller properties. Limited service, so like I don't want anything that has like a restaurant attached to it or anything like that. I want seller financing, right? Guys, that's part of the reason that we transitioned to boutique hotels, is because there's this amazing opportunity right now where you've got an entire generation of owners who are retiring. Kids don't want it; they don't want to rent anymore. They just want to get out of these deals. And we've talked to a lot of owners in that exact same situation who are not only understanding of what seller financing is, but they're just like literally promoting it with the property, you know? So seller finance notes is super important to us, 10 to 30 rooms, and we're specifically looking at like a $1 to $3 million purchase price. And we're also looking from a market perspective, like I don't want anything too rural, so we're looking either suburban or vacation markets.
Next question.
Thank you. I'm Irvin. It's good to be here. Very informative. Let me ask you this. What was your primary source of income before getting into the investment industry?
But before investing in real estate, what was it? Yeah, it was just my day job, right? So I worked a traditional W-2, and I was fortunate enough to do well in it, and we saved a lot of money from that to kickstart the real estate investing journey.
All right. The reason why I asked, because I'm a retired builder, and my son, he couldn't come in this morning because he's putting a function together for later on. But however, he and his wife are doing extremely well all across the city and Houston, and young socialite, and I'm trying to get him to calm down a little bit. And because I told him, I said, it's not all about money. Young people die of heart attacks as well, you know. But they're doing extremely well. And what I was doing, I was building them for them. And Airbnbs and all that, prime location, real high end. And the market is there. But he's doing well. And I'm just listening at you. I was wondering, I'm trying to get him to kind of stream down a little bit. Because, you know, sometimes you say, Dad, I just have to go and get away. They have properties all in Florida. I said, son, I told you, young people die of heart attacks. You have to be careful. It's not all about $1.
All right. Thank you. Next question.
How's it going, Tony? My name is Jarek with Campbell and Jordan Properties. I've actually seen you on BiggerPockets podcast. But my question is, how do you vet banks as a new investor? What ideal terms are you looking for?
That is a great question. The first thing I would say is that I think a lot of investors make the mistake of not talking to enough lenders. And notice I said lenders, not banks. Banks are just one of the places you can go to get money. But I think the podcast that I run is the Rookie Podcast, so I have the good fortune of talking to a lot of rookie investors. And again, they talk to their local Chase branch, and they think that that's the end all be all. But I think the best analogy for the lending industry is the ice cream industry. Like, ice cream, you can go anywhere and buy ice cream, right? But you've got Ben and Jerry's, you've got Dairy Queen, you've got Baskin Robbins. I can go into Baskin Robbins and I can get their flavors. I can't go into Baskin Robbins and buy Ben and Jerry's. The lending industry is the exact same way. They all sell mortgages, right? They all sell ice cream, but everyone has their own flavor. And depending on who you talk to, you might get the flavor that works best for the deal that you're looking at. So again, when I first started, the credit union that I was working with said, we'll fund the entire deal. I could have taken that term sheet to Chase, and they would have laughed at me, I would have said, yeah, we don't do that here, So I think the most important thing is not like, hey, what terms am I looking for? But it's walking into a bank and saying, here's what I'm trying to accomplish. I think people make the mistake of saying, hey, I want a 10% down loan, or I want this kind of loan, I want this kind of loan. Don't say that, because now you're restricting what they can offer you. Just go and tell them, hey, here's what my goal is. So like for me, my goal was I want to buy a property, renovate it with zero money out of pocket. What do you have? Hey, here's what we have for that, right? So terms, I think, are those will vary from deal to deal, but the most important thing is talking to a volume of lenders, credit unions, private money, hard money, banks, regional, big ones, small ones, and seeing what they offer. That's how you get the best thing. And to your point earlier, Emile, about ChatGPT, I actually did this as like a example on the podcast, but I gave ChatGPT the city that I live in, and I said, I want you to find within a 50-mile radius 100 different banks and credit unions that are not national chains, and give me their email address, their phone number, and their website. And like 10 minutes later, I had a list of 100 local banks and credit unions that I could go call. So it's easier than ever now to even find those opportunities. But I think that's the best way to do it right now.
So if you don't have ChatGPT on your phone right now, download it right now. In a 50-mile radius of New Orleans, give me 1,000 lenders. So do it before I do. Great.
Thank you. Thank you so much, Tony, Domonique, and Emile, for sharing this and for being so open and transparent. I'm inquiring, how did you stay focused with your buybacks, especially if you have partners and all these other people investing with you, and to focus in on what you really want? I started doing an investment group, and so many times people have all these great ideas. Why don't we do a mobile home park? I'm like, I'm not trying to do a mobile home park. This is what I'm bringing you in here for. So how do you continue to do what you want to do, especially with other people's money?
Yeah, that's a great question, right? So like shiny object syndrome, right, is what you're asking about, Grace. I think to my core, I just have like an entrepreneurial mindset. Real estate is what I do now, but through my 20s, I tried so many different things. I had a tutoring company at one point in college. I tried to sell, things online. I had a blog about basketball shoes where I was like making money from ad revenue. I've tried so many different things. And I never found success in any of those things because I didn't actually commit to any of those things. And I was hoping to jump in and find like immediate success. And when I didn't find that immediate success, I would move on to something else. And there's something to be said about building expertise and building skill in one area. So when we made the transition to short-term rentals, my wife and I had a very real conversation about this. And I was like, I think if we're going to do this, we should commit to doing it for at least 5 years. Like, let's not do anything else but this one thing for 5 years. And let's see how good we can get at it. And I think that singular focus, that kind of clarity of what it is we're going to accomplish, allowed us to put all of our efforts into one thing. And I think that's how we were able to get, in a relatively short period of time, pretty damn good at being short-term rental hosts and operators, because we focused on one thing. So I think all of us, we kind of struggle with that idea of shiny object syndrome. But I think one of the most important mindset shifts I've had recently is that it is physically impossible to do everything. Like, of all the aspirations and ambitions we have in our lives, there's no physical way we can accomplish all of them. And I'll go back to Warren Buffett because I heard this quote from him recently, but like his advice to someone who was young was like, dude, like if you really want to be great at something, think about the 5 things you want to accomplish in life, like the 5 biggest things you want to do, rank them in order of priority, circle number 1, scratch off numbers 2 through 4, and never look at them again. And that's the kind of mindset that I'm trying to take into this next phase of our business life, is just singular focus, getting really good at one thing.
We have time for two more.
Hey, my name is Shannon. Thanks so much for being here. I'm a little bit of a newer investor. I've done some new construction, landlord as well. But one thing, I have 2 questions. Being a mom, I know that you're a father. And so one thing that's near and dear to my heart is just breaking generational cycles of poverty. And so how are you intentional about passing that mindset down to your children? How involved are they, if at all? in your business? And then my other question is around asset protection. How are you guys being intentional about structuring things? Are all of your Airbnbs in their own LLC? Do you have a umbrella company maybe for the boutique hotel? How have you structured those things to keep it clean and organized and protected?
Yeah, two great questions. So yeah, my two youngest, my youngest is 5 months. My middle is almost 2, so they're not too into it yet. But my oldest is 17, and he's definitely taken an interest more recently. We're actually going to Oklahoma City in about 2 weeks to go look at some flip properties out there. So he's coming with me on that. He spent the last summer cold calling homeowners trying to get his first wholesale deal. So he's definitely taken an interest in it. But it wasn't because I like forced it on him, you know. I think just him seeing what we've been up to. Like, we started investing when he was, you know, I don't know, like a preteen, right? So he was old enough to kind of see what was going on. He was, you know, there with me when I lost my job. Like, he saw this transformation that we've had over the last couple of years. So I think for him, just naturally, he's wanted to pick it up on his own. And for me, it's just trying to make sure that I'm a resource for him in whatever he wants to do or however he wants to approach it. And I'm just happy to be there with him as he's going on that journey for himself. But yeah, I'm pretty damn happy for him, you know, that he does want to do this. So that's been cool. The second part of your question, though, probably a slightly more involved answer. Asset protection is one of those things that also gets really sensationalized, I think, on social media, because one person made a video one time on their whiteboard about, hey, here's how I structure my LLCs, and now everyone's made that same video, right? I think, first let me say, I'm not an attorney, you know, so go talk to an actual attorney. But the first thing I'll say is that I think you can overcomplicate asset protection very quickly, okay? My attorney gave me this analogy once of, you should think of asset protection as like your layers of clothing, right? And we're all walking through slightly different types of weather. If you're someone with a lot of net worth, with a lot of assets to lose, you're walking through a blizzard, right? So you got to make sure that you're like, I'm from California, so I don't know, what are people wearing blizzards? What do you like, a parka? I don't know, what do you put on in a blizzard? But you got like multiple layers, right? If you've got no assets, what are you protecting, right? You can walk outside in shorts and a t-shirt. So I think making sure that you're aligning your asset protection with the actual assets you have to protect. Because people don't understand, like, there's a cost to asset protection. You have to pay attorneys to set these things up. In California, every LLC that we set up has a minimum annual fee of $800 per year. I then have to pay a CPA to file tax returns on every single one of those LLCs. I have to pay a bookkeeper to keep the books for all of those LLCs. Like, it gets expensive. So I don't think that someone starting out, my own personal opinion, right, go talk to an attorney, but I don't think someone starting out should necessarily have a separate LLC for every single property. I just think it's, again, unless you have like an immense amount of wealth already, but I think for the average person, that's probably too much. Now, as you start to scale, maybe it's like, hey, I keep X% of my net worth in one LLC. Like, I don't want any more than 20% of my net worth to be in one LLC. Okay, cool. Then what's your net worth? Divide that up, into 5 equal parts. There you go. So that's my advice to folks is, like, make it scale with your portfolio. We've got a lot of different LLCs now because we've kind of scaled to that point. But for folks who are just getting started, make it match with where you're at and what you're trying to protect.
Yep, we have time for one more.
Hey, my name is Gian. I'm 19 years old. I'm a wholesaler that you mentioned earlier. But my question is, for your first property, for anyone who wants to buy their first property, what's a couple of ways that you feel that would be the best way to, get in that field?
Yeah, absolutely. Can we clap for him for being 19 and being in this room? That is amazing. I think that you, like, as a wholesaler, you have a skill set, or at least you're developing a skill set that is incredibly important to every single person in this room. Real estate transactions don't happen if no one ever finds the right deals to transact on. So I think for someone who's just getting started, if you've got that skill set, I would lean into that. So instead of taking an assignment fee on a deal, go to Dom and say, Dom, I've got this killer deal, but hey, can we partner on it? And don't even ask for, like, hey, I don't need 50-50, give me 10%. Because the goal of that first deal isn't for you to make a ton of money. I don't know anyone that's ever retired off of their first deal. Hasn't happened. So that's not the purpose of the first deal. The purpose of that first deal is to educate yourself, to give you that foundation, give you that proof of concept. So I would take the skill set that you already have, whatever is the best deal that you've ever found. The deal that you're going to get your biggest assignment fee on, don't wholesale it. Take it to someone else and JV on it. And then let them show you the ropes of how they put their deals together. Let them bring you're 19, you're probably not super bankable yet, which is fine. Let them bring the financing, right? All of the gaps that you feel that you have right now, you can solve by taking your ability to find amazing deals and then partnering with someone else who can fill in those gaps for you, whether it's the capital, whether it's the bank loans, whether it's the management expertise, whatever it is. Find a really great deal and then partner with someone else to fill in the gaps.
And I want to highlight his skill set that he might not even know that he has already. So the reason he's here, he cold texts me from a Zillow lead. Cold texts me, send me the deal. I just replied, come to Investor Fest. And he ended up coming. So give him a hand clap for that. And everybody, put your hands together for Tony Robinson.
Tony, real quick before we wrap up, what is the best way for people to stay connected with you, see what you're up to? I know you host some events sometime and stuff too. What's the best way for us to connect with you?
Yeah, before I do, can we just give both of these two a big round of applause for putting this together? And seriously, guys, thank you for bringing me out. I hope you guys got some value from me being here. And thank you to all you guys for asking some amazing questions as well. And my hope is, just you guys learned something from my story. I think the last thing I'll say is that I am not a special person by any means of anything. I grew up single-parent household. I had my son when I was 16 years old, like almost flunked out of college. Like I am not special by any means. But I've just been super fortunate enough to be in the right room with the right people and then action the things that I learned in those rooms. And I think if you can do those two things consistently, of surrounding yourself with the right people and just doing the things that those successful people are telling you to do, you tend to get ahead a lot faster. So anyway, thank you guys for being with me today. If you guys want to get in touch with me, Instagram, I'm at Tony J. Robinson. BiggerPockets, you guys can find me there. And then my wife and I run the Real Estate Robinsons YouTube channel. You guys can find us there as well.
Awesome. Thank you so much, Tony. This was awesome. And before we kind of set everyone loose to network and connect further, just wanted to highlight real quick the screen over here. So if you guys enjoyed being in the room today, getting connected, meeting people, potentially doing new deals with new people, there are a ton of great monthly local meetups that happen all the time in the surrounding New Orleans area. So I threw some of the info up here on the screen of when they happen, what time and dates they go on. But if you want to get in more rooms like this, get more involved, definitely check out the ways to do that every month at these local meetups. And then these Investor Fests happen about once a year. But definitely, we're here for the next hour or so, hang out, network. There's a photo area in the back, take some photos, meet some new people, and thanks again for being here.